Hey, I'm an analyst with Talk Tickers, and today we're diving into one of the most misunderstood and maybe mysterious-sounding corners of the financial world, dark pools. They play a massive, massive role in how our markets work, and we're going to break down exactly what they are and why they matter. So check out this number, 40%. What do you think that represents? Well, that's roughly how much of all U.S. stock trading happens completely off the public exchanges, away from the public eye. Yeah, that's a huge chunk of the market operating in the shadows.
So the big question is, how did this happen? How did nearly half the market just go dark? I can tell you, it wasn't by accident. It was a slow evolution, and it was born out of a very specific and very expensive problem. Okay, to really get why dark pools even exist, you have to put yourself in the shoes of a massive institutional investor. We're talking about huge pension funds, mutual funds, the really big players.
And for them, trading on a public exchange is kind of like shouting your entire game plan in a packed stadium. It's all about something called market impact. Imagine you need to sell 1 million shares of a stock. The second that huge sell order hits the public market, everyone sees it. And what happens? Other traders react, the price starts to drop, and you haven't even finished selling yet. That little move can cost these institutions, and by extension their clients, which could be you and me, millions and millions of dollars.
So before dark pools were really a thing, the options for these big players were not great. They were slow and they were super risky. An institution might try to work the order, as they called it, breaking it into these tiny, tiny pieces over several days, just trying to fly under the radar. But even then, you risk tipping your hand. High-speed traders could spot the pattern and basically trade against you. So the key takeaway here is that the very transparency that's supposed to be a good thing about public markets had actually become a huge liability for the biggest investors.
And you know how it goes. When there's a billion-dollar problem, someone's going to come up with a billion-dollar solution. And that solution came in the form of something called alternative trading systems, or ATS. And that's the official regulatory category for what we all just call dark pools.
So what is an ATS? Well, officially, it's a trading venue that isn't a national exchange, but it does the same basic thing. It matches buyers and sellers. Just think of it like a private club for trading, one that's regulated more like a broker-dealer than, say, the New York Stock Exchange.
This right here, this is the fundamental difference. You've got lit markets versus dark pools. Lit markets, like the NYSE, are all about transparency. By design, everyone can see the order book, all the bids, all the asks. Dark pools, the complete opposite. They are private venues where orders are hidden. There's zero pre-trade transparency. You literally have no idea who wants to buy or sell or for how much until after a trade has already happened.
And that secrecy? Well, that's the whole point. By hiding those huge orders, dark pools help institutions avoid that whole market impact problem we talked about. They can often get a better, more stable price and avoid tipping their hand to the rest of the market. They might even find a perfect match right at the midpoint between the public bid and ask price, which is a win-win for both the buyer and the seller.
But of course, it's never that simple, is it? Solving one problem ended up creating a whole new one. Because the very secrecy that makes dark pools so useful also makes them incredibly controversial, and that led to a whole tangled web of new challenges.
See, when all this trading is happening in the dark, it opens the door for all sorts of potential conflicts of interest. Suddenly, you have to ask, who's actually running this pool? Who else is allowed to trade in it? And are they treating everyone fairly? These weren't just theoretical questions. They became the focus of some major regulatory investigations.
This quote from the SEC really nails the issue. Market participants deserve to make informed decisions about where they execute their orders. Basically, investors need to trust that the game isn't rigged against them. But sometimes it was, which brings us to a perfect case study.
Yeah, let's talk about the SEC's case against Citigroup's dark pool, called Citi Match. This is a wild one. Citigroup had told its clients, hey, this is a safe space, no predatory high-frequency traders here. But the SEC found that wasn't true at all. In fact, 2 of the most active users in the pool were HFTs. And it gets worse. They were secretly routing almost half of the orders to other places without telling anyone, and then sending out fake confirmations saying the trades happen inside Citi Match. It's a crystal clear example of what can go wrong when there's no sunlight.
Okay, so after stories like that, you can bet regulators had to step in. They couldn't just get rid of dark pools. They do serve a legitimate purpose, remember? But they definitely needed to shine some light into these dark corners of the market.
And you can really see this cat-and-mouse game play out in the regulations over time. Back in 1998, Regulation ATS gave them their first real framework. Then, ironically, a 2007 rule called Reg NMS, which was meant to protect investors, actually made the market so complex that it pushed more trading into dark pools. It wasn't until after those big investigations around 2014 that we saw some real regulatory teeth. Europe came out with Mifid 2, which put hard caps on dark trading, and here in the US, the SEC introduced Form ATS-N, which finally forces these venues to publicly disclose exactly how they operate.
But the story doesn't stop with regulation, of course. The market is always adapting. And that line between the lit public markets and the dark private ones, it's getting blurrier every day. So what's next? What does the future of trading actually look like?
Looking ahead, market experts are watching a few key trends. First, you've got hosted pools. Think of these as private VIP rooms inside an existing dark pool, where brokers can get even more control over who they trade with. Then there's bilateral trading. This is basically a direct private pipeline for trades between two big parties, completely bypassing other venues. And then there's the big one, a potential overhaul of the order protection rule, a core piece of market regulation that could fundamentally change how and where all our orders get routed.
Which brings us back to the central dilemma, doesn't it? Dark pools were born from a need for efficiency, but that efficiency came at the cost of transparency, raising all these serious questions about fairness. As technology and regulation continue to reshape our markets, the central challenge remains, finding the right balance between the two.
This is not financial advice.